The following program is paid for by Lifespan Wealth Management, providing financial advice since 1993. At Lifespan Wealth Management, the main thing they do is provide retirement planning and advice and manage their clients' investment accounts. If you're looking for a financial advisor, contact their office at 478-922-8100 to set up your complimentary consultation. Lifespan Wealth Management has offices in Macon and Warner Robins for your convenience, and you can learn more about them by visiting their website at retirerelax.com. While you're on the site, visit the special report section, which provides great financial education information on many different topics. You can also sign up to receive their digital feeds, which are short videos providing great information relevant to retirement, investing, and matters that affect your money. They also offer seminars to the community at no cost. If you're looking for a guest speaker for your church or civic organization, give them a call to discuss the topics you would like them to cover. Again, their contact number is 478-922-8100. Now, from the Macon studio of News Talk 940 WMAC, it's time for Your Money with Sherry Goss, Randy Goss, Jonathan Eisner, and Corey Albrecht.
Good morning, everybody.
Good morning. Well, it's just the three of us here this morning. Jonathan's having home repairs, so
that's so fun.
Oh yeah, everyone loves that. Contractors and people not showing up
and having to write big checks.
Oh yeah, lovely.
So, market update. This week, the Federal Reserve delivered exactly what markets were expecting, and in many ways, that's a positive. The Fed held interest rates steady, continuing its pause as inflation gradually trends lower and the economy shows resilience. While that decision grabbed headlines, the real takeaway is stability. After years of aggressive tightening, the Fed is now in a position to wait, and that's typically a supportive backdrop for markets. Yes, there was some disagreement among policymakers, which reflects uncertainty, but it also highlights something important. We're getting closer to a turning point. When the debate shifts from how much to hike to when to cut, that's usually a sign the cycle is maturing.
That's right. So how did the markets react to all this? Well, we saw some short-term volatility. Stocks pulled back modestly, and bond yields ticked higher. But most importantly, there were no major disruptions. Markets largely absorbed the news, which suggests investors were already positioned for this outcome. And that's where there's a case for being bullish. The Fed isn't tightening further. The economy is still growing. Corporate earnings, broadly speaking, have held up better than expected. And we'll talk more about those issues in just a few minutes. That combination of steady policy, resilient growth, and stable earnings has historically been constructive for equities over time. But it's also worth noting, even though expectations for immediate rate cuts have been pushed out, that doesn't eliminate them. It simply extends the runway for this expansion. In the March CPI, inflation shows that a 3.3 year-over-year growth, and the March figure showed almost a full percentage point increase over the previous month. Core inflation, which excludes food and energy, was at 2.6%. So with these numbers, it was no surprise that the Fed held the line on rates. It was the right call.
I agree, and here's the bottom line for investors. There wasn't an exciting Fed meeting, but it was a reassuring one. Policy is stable, the economy is holding, and while timing remains uncertain, the next meaningful move from the Fed is likely lower, not higher. And in markets, that kind of clarity, even if gradual, can be a powerful tailwind.
That's right.
Next up, U.S. economy sped up in the first quarter thanks to an AI boom that shows no sign of slowing. The U.S. economy sped up to a solid 2% annual growth rate in the first quarter, emphasized by a boom in artificial intelligence that appears to be gathering steam. Gross domestic product, the official scorecard of the economy, was also aided by a rebound in spending by the federal government after a record-long shutdown in the fall.
Yeah, and economists were expecting a 2.2% growth rate in the first quarter. GDP rose a smaller 0.5% in the final 3 months of 2025. And here's some key details. Consumer spending, which is the chief economic engine of our country, rose at a 1.6% annual rate in the first quarter, down slightly from a 1.9% rate in the prior 3 months. Household spending accelerated in February and March after a chilly start to the new year. Business spending on equipment, particularly artificial intelligence, jumped 17.2% in the first quarter. Government spending expanded at a 4.4% rate after a 5.6% decline in the prior quarter. A bigger trade deficit shaved 1.3 percentage points off the GDP. But remember, that a bigger trade deficit lowers the GDP, and that's in an accounting sense, but it doesn't automatically mean the U.S. economy is any weaker.
The resilience of the economy was even more impressive based on a measure of sales to private companies and individual Americans. These sales rose at a healthy 2.5% annual pace, up from 1.8% in the fourth quarter. In the big picture, the war with Iran hasn't slowed the economy, at least not yet. Some economists see a letdown coming, but others expect the effects of the war to fade soon. And then you see the AI boom continuing its current trajectory. Federal Chair Jerome Powell said the U.S. economy has been remarkably resilient for some years now, and that is just powered through shock after shock.
Yep. It's amazing how well the stock market has held up. Okay, so now we've discussed how well the economy is holding up. So let's discuss how this past week's corporate earnings extravaganza went. Well, it's been one of the busiest and most important weeks of the earnings season, and so far, corporate America is largely delivering good news. Not surprisingly, big tech is front and center. 5 of the so-called Magnificent Seven, including Alphabet, Amazon, Microsoft, Meta, and Apple, reported within a 48-hour window, setting the tone for the entire market. And the headline, growth is still very much intact, especially when it comes to AI.
Amazon boasted a standout quarter with revenue jumping 17% and its cloud business up nearly 30%, signaling that the demand for AI infrastructure remains strong. Microsoft echoed that strength with the revenue up 18% and Azure growth near 40%, reinforcing the idea that the enterprise spending on AI and cloud isn't slowing down. Alphabet also impressed, helping push markets higher, while Meta actually beat expectations, but saw some pressure on the stock due to aggressive AI investment plans. Still, that spending is being viewed by many as a long-term positive, not a red flag.
Yeah, and that's a big flip from a quarter or two in the past when the buzz was, this is an AI bubble and when's it going to pop?
Right. Beyond tech, the story is just as encouraging. Industrials like Caterpillar and healthcare names like Eli Lilly posted strong results and upbeat outlooks, showing that earnings strength is broadening beyond just tech. Put it all together, and earnings are doing exactly what bulls want to see, supporting stock prices, even in the face of higher oil prices and global uncertainty. In fact, markets are on track for one of their strongest months in years, largely thanks to these results. Bottom line, corporate profits are holding up, AI-driven growth is accelerating, and for now, earnings continue to justify the market's resilience, which is awesome. All right, next up. The number of Americans filing for unemployment benefits tumbled to their lowest level more than 50 years last week, despite a number of economic headwinds, including the war in Iran. U.S. jobless aid applications for the week ending April 25th fell by 26,000 to 189,000, down from the previous week's 215,000, and that's well below what the analysts were expecting.
Yep, that's right. Analysts were expecting 214,000 new applications. Filings for unemployment benefits are considered a proxy for U.S. layoffs and are close to a real-time indicator for the health of the job market. This week's numbers for new jobless applications was the fewest since September of 1969, and that's a nice record to break. Despite dwindling layoffs shown in government data, the Iran war, now in its 9th week, has injected a large degree of uncertainty about how it will affect the U.S. and the global economies, even as Iran and the U.S. remain under a ceasefire agreement.
U.S. financial markets have rebounded near record levels, and prices for a barrel of U.S. crude oil remains elevated around $114, which is 50% higher than before the war began. As a result, gas at the pumps is also higher since the war began, with the average price of a gallon of regular gasoline selling for $4.30 on a national average, which adds economic pressure to households with increased costs. The Labor Department reported earlier this month that U.S. employers added an unexpectedly strong 178,000 new jobs in March, nudging the unemployment rate back down to 4.3%. That followed a surprising large loss of 92,000 jobs in February.
I'm really glad that Kemp shaved the 30 cents or the 30 cents off the price of
gas tax
in the United States, which is really helping people out a lot. And I don't even know if everybody knows about that.
Yeah.
But that has helped keeping you from having these super high rates.
And I believe it was supposed to expire in June, but I'm pretty sure, based on what we're reading in the news, this is going to be a protracted event.
I'm
in
sure he'll
Iran.
extend it.
Because I read this morning that even if they open the straits back up, it's going to take 40 days beyond this, like today, for oil to
Yes.
get back to normal.
Yep. So unemployment applications down and employment up. I like where this is going. Weekly jobless aid applications have stabilized in a range mostly between 200 and 250,000 since the U.S. economy emerged from the pandemic recession. However, hiring began to slow about 2 years ago and tapered further in 2025 due to President Trump's tariff rollouts, his purge of the federal workforce, and the lingering effects of high interest rates meant to control inflation.
Yep. All right. No peace plan? No problem. Let's talk about why the wartime market keeps rising. To put it bluntly, bad news stirs even greater interest among investors who see only prospects for the stock market to keep setting records. Days after the United States and Israel attacked Iran, Anthony Reid was at home in Dallas wondering whether a doomsday energy shock for the global economy was precisely the time to make a big bet. Reid stared at his phone and considered plowing a chunk of his savings into shares of Robinhood. He had a reason to hold off. First of all, it would be a lot of money for a 30-year-old delivery driver new to investing to do. And second was his historic oil disruption from a war in Iran could turbocharge inflation and hammer stocks. Reid, a father of 2 boys, had also heard that the best time to invest when others were scared, but he went against his intuition and clicked buy.
There are times when bad news is bad news for markets. There are times when bad news is good news for markets. Then there are times like this when bad news doesn't even register for investors, like the guy in this story. From day traders to hedge funds, investors are once again running full speed into stocks and loading up on risk. A skeptic could find plenty of cause for gloom and doom. Oil tankers still can't freely traverse the Strait of Hormuz. The two sides were still trading threats when the next round of U.S.-Iran peace talks was put on pause. President Trump said Tuesday he would extend the ceasefire, but the U.S. would continue to blockade Iranian ports. Yet the 3 major U.S. stock indexes have marched back to pre-war levels and then some. The tech industry's Magnificent Seven gained $2.5 trillion in market value over the recent 8-day stretch.
Staggering.
Speculative bets are back. Allbirds, the one-time footwear favorite of techno-optimists in the 2010s, gained almost 600% in one day last week.
Good grief.
After pivoting to what else? AI.
I've never heard of Allbirds
I ain't either.
shoes. Doubters warned that markets are increasingly driven by you only live once, YOLO bets, and momentum-chasing algorithms, and as a result are getting dislocated from reality or at least oblivious to bad news. A flood of information has left even the biggest traders struggling to parse facts from fiction. At the same time, Wall Street is confident that markets are a constraint on Trump, that he will do what he needs to reverse a sell-off, even if that means walking back a social post from the day before. Grizzled investors say the run-up merely confirms the age-old wisdom of keeping money in markets through turbulence. Near-term threats pale in comparison to a U.S. economy that has weathered crisis after crisis in recent years, often with help from Washington. America's massive oil and gas output also shields the U.S. economy from the shocks that boosted inflation and slowed growth in the 70s. The market's current leap to new records reflects the same impulse to buy the dip that propelled stocks during the COVID-19 pandemic and last year's tariff turmoil. 4 of the S&P 500's 5 biggest daily gains of this year have come during the war.
Yep. And for many traders, when stocks go down, it is a time to buy more. After sliding for much of March, Reid's Robinhood shares surged 31% in a single week. If stocks fell again, he said he would dump more money into the markets. It's a risky game, even if peace talks prevail. The ship traffic resumes through the Persian Gulf, and many analysts believe energy prices would be higher for the rest of the year. And that's a new era of conflict and economic nationalism that could plague markets well beyond that.
Wall Street traders learned an important lesson when Trump's tariff policies briefly upended global markets last year, dragging equities to double-digit losses in a matter of days. Some, like Alonzo Munoz, chief investment officer at Hamilton Capital Partners, viewed it as a clearance sale and bought up stock. He scored big when Trump reversed his tariff stance and the markets ripped. Munoz says that the same dynamic developed in the Iran war. On a Monday in mid-March, he stared out of his Manhattan skyline office view from his 85th floor and decided he didn't want to miss out on another blistering rally. This feels like Liberation Day, he told clients.
Yep. His firm snapped up tens of millions of dollars worth of stocks, including Tesla, Amazon, and Oracle, and believes the Trump administration is willing to pivot when the markets get shaky. As Trump's rhetoric effectively beats down short-term surges in oil, investors have learned to live with the prospect of higher for longer energy costs, even as consumer surveys shows a plunge in economic outlook of Americans. Big banks, however, reported a blockbuster earnings this month, and Wall Street's top executives signaled the show will go on. After all three major U.S. indexes fell more than 7% from the start of the war, pushing the Dow and the NASDAQ into correction territory, they have since boomeranged higher than when the drones and missiles started flying. Fuel-hungry transportation stocks bounced as a sign of growing industrial output. And not to be outdone, beleaguered software shares and private credit equity firms rebounded too.
When the rally kicked off in recent days, data indicated it was more about technical trading strategies than confidence that the war was ending. Hedge funds, which had bet against the market as volatility climbed, started rapidly unwinding those short positions by buying up shares. There is an old Wall Street saying that nothing changes sentiment like price, and soon the rally was gaining steam. Professional investors grew more optimistic, buoyed by the approach of first quarter earnings season, and analysts were still projecting double-digit profit growth, making cheaper shares look like a bargain. Trend-following hedge funds went on a buying spree, which just added to the momentum. Munoz says his investors seemed less troubled by the swings than before. As stocks fell during the end of March, his phone remained surprisingly silent. Clients have gotten used to these sharp dips, he said.
Yep, some investors relish them. When Danner Drake, 54, saw the news of the NASDAQ correction flash on his office computer, he opened up a brokerage app. Almost irreflexively, he sold 10% of his holdings in a plain vanilla index fund and plunged it into ProShares Ultra QQQ, which is a leveraged exchange-traded fund that promises triple the return, and that's positive or negative of the NASDAQ 100. After tapping the brakes in March, individual investors such as Drake started buying again. In April, juicing gains in popular names, including Palantir and Microsoft and Robinhood. But Drake tries to get in early if he can, right after the major indexes suffer a steep drop. For years, it has been his strategy to take on some leverage, wait for the bounce, and then collect the gains when the stock snaps back.
A longtime investor who has held on through the dot-com crash and the 2007-09 recession, Drake said his experience has instilled a kind of blind faith in the American stock market's ability to recover after just about any crisis. Why are markets racing back to records? I have no idea, he said. It doesn't matter why it goes down. The Iran war, COVID, whatever, Drake said. All these times when the markets drops, it doesn't even matter to me. I just buy more.
Yep. All right. The Iran war boosts a fast-growing Chinese industry, turning coal into stuff, and that's what they're doing. The historic spree of coal burning that powered the Chinese economy rise is finally leveling off, but the fossil fuel does have other uses, and the war in Iran is giving one in particular a big boost. The conflict has been calamitous for much of Asia's petrochemical industry, which relies on oil from the Middle East to make the ingredients from everything from PVC pipes to acetaminophen. The effective closure of the Strait of Hormuz has meant higher costs and, in some cases, shortages.
But the war is proving a boon for Chinese producers who make chemicals as well as liquid fuels from coal. Not only are they insulated from rising costs, but they're benefiting from higher prices for their products. In response, they're ramping up production. Demand for coal from the chemicals industry was up 11% year over year in April. Shares of coal-based chemicals producers have soared since the war started, while those of oil-dependent revivals have languished.
Even before the Iran crisis, this business was taking the shine off China's tentative progress in decoupling growth from fossil fuel consumption. The chemical sector was the main reason why emissions from the Chinese industrial sector climbed last year. According to sources at nonprofit organizations, they estimate that the sector used 440 million tons of coal last year, nearly as much as the total U.S. demand.
Wow.
The trend is a reminder that despite the breakneck growth of green electricity in China, the world's factory still largely runs on polluting processes that are hard to electrify.
Yeah, China's coal-based chemical play emerged because of coal miners searching for new markets aligned with Beijing's energy security priorities. For a country that will never be self-sufficient in oil, the ability to turn coal into chemicals is a vital geopolitical shock absorber. The idea of converting coal into useful products was born out of a similar energy security anxieties a century ago. Many of the chemical processes underpinning the modern industry were developed by a German scientist in the 20th century. They allowed oil-deprived Nazi Germany to turn coal into fuel and even margarine during World War II. The same core technology is used to produce transportation fuel in coal-rich South Africa.
Now, another war is justifying Beijing's decision to view this as a critical sector. Producers improving margins also boost the case for building more plants. They would have to align with China's climate goals by using green electricity and carbon capture technology, but few industries are tougher to clean up. Spinning coal into stuff of modern life is inherently less efficient than the conventional petrochemicals industry and far more carbon intensive.
Yeah, I was fascinated by this article, and I did some research on the environmental impacts of converting coal into modern products like plastic or chemicals, such as compared to the environmental impact of using the petrochemicals, oil. It turns out that the production of primary chemicals, which is the building blocks for modern products, using coal is far more carbon intensive than oil. A study showed that the emissions intensity to convert coal to olefin, which is the fibers you would find in a man-made fabric, would produce 10.4 tons of CO2 compared to 10.4 tons of CO2 per ton of the produced product, compared to petrochemicals, which produce between 0.5 and 1.2 tons of CO2 of the produced of the produced product. It's just inherently a dirty product. So it sounds like it's a terrible thing even for China to try to justify.
Aircraft technicians make six figures and airlines can't find enough of them. The aviation industry faces a shortage of aircraft maintenance technicians, with more than 40% of mechanics over age 60. The airline industry is running out of the people who keep planes flying safely and on time, the result of a ticking demographic time bomb in the field.
Yeah, there's a real shortfall now, and it's projected to get worse. More than 40% of America's aviation mechanics are now over 60 and fast approaching retirement. And because airlines face a massive backlog of new plane orders, these mechanics are maintaining some of the oldest passenger and cargo fleets in decades. That means the work is steadily mounting. Next year, the labor shortage is projected to be nearly 7,000 certified mechanics in North America, 12% fewer than the industry actually needs. That doesn't include an estimated shortfall of 15,000 non-certified maintenance personnel. Once a technician obtains their certifications from the training school, they can start at about $27 to $30 an hour, depending on the level of the certifications.
Major airlines, which have ramped up their own training programs, are at the top employers of choice for many aircraft technicians. And carriers like United have offered signing bonuses as much as $75,000 to recruit workers for hard-to-fill hubs in recent years. At United, licensed entry-level technicians make about $81,000. After 8 years of wage top-outs, and technicians can make roughly $135,000, and that's before overtime. Yet pay increases and other incentives have contributed to a catch-22 for the industry. Maintenance technician schools report having a hard time retaining instructors because they are drawn into the private sector with large bonuses and salary packages. Basically, they can get paid much more working in the industry than teaching. Meanwhile, 1/3 of the seats in the U.S. aviation maintenance technical schools remain empty. Lack of awareness is one reason.
So the Technical College System of Georgia offers a free program, and here's what the website says. The Aviation Technology Program offers courses to teach skills for aircraft, assembly, structural maintenance, and technology. To learn more, go to tcsg.edu/free tuition, because this program is free. I don't know if it's what they want people to be taking or what, but you need to go check it out if you're wondering about getting a job like this. All right, tenants in common. I had a call from a client this week, and her husband passed, and she didn't realize their property was issued to them as tenants in common. This means that his share of the property passes by his will and does not automatically pass to her. His will names his children as his beneficiaries, so they will own 50% of the house she lives in. It is likely that they will sign their share of the house back to her, but this is a scary problem. I was speaking to a group of widows and widowers at McCullough Funeral Home last year, and 2 people in the room said that their homes were titled this way. Thankfully, the deceased spouse had a will, and in that document they stated that the house went to the spouse. So check the titling of your home to make sure you have this right. Joint tenants with right of survivorship would be the way a couple should have their title named if they want their share to go to their spouse.
Yeah, that's good advice, Sherry. And just recently we had another case exactly like the one you're talking about, except the other beneficiaries, which were where the deceased spouse's children are trying to make the widow buy their 50% of the house.
Yes.
And she doesn't have the money to do it.
It's terrible.
And it's a very bad scene.
Now on to natural disasters that are rewriting home insurance costs. The old home insurance rules are being upended. For decades, coastal states with hurricanes bore the brunt of rate increases, while inland states enjoyed cheap coverage. Now, hailstorms, wildfires, and wind damage are hammering places once thought to be shielded from the worst rate hikes. Hill-prone Iowa has seen approved home insurance rate increases 91% since 2021. In Florida, despite the hurricane risk, the increase is only 35%.
Yep, home insurance premiums can vary dramatically depending on where you live. Crossing a county line can more than double the cost. Hurricanes still drive high premiums. 46 of the 50th costliest counties nationwide are mostly found along the Gulf Coast. Hurricanes as the primary threat. The data estimates ensures state-approved rates rather than actual premiums paid, which might skew prices up in the risk areas.
The next 50 most expensive counties included areas of Oklahoma and Texas where hail, wildfires, and tornadoes pose the biggest threat from nature. Home insurance rates nationally, have far outpaced consumer prices since the pandemic, and it isn't all weather-related. Rising home values and higher construction and labor costs are also driving up premiums. Homeowners in some high-risk areas are seeing rates spiral if they can get coverage at all. Homeowners in California reported their annual premiums had shot up more than 9 times their premium from just 2 years ago. The reason? Wildfires, which are scorching homeowners' chances of cheaper insurance in many states.
Damage from hail is also on the rise. Verisk, a catastrophic modeling firm, estimates potential insured losses from the severe thunderstorms of around $60 billion a year, almost double its modeled losses from just 4 years ago. The state you live in can have a big influence on how much you pay. Crossover from Cherokee County, North Carolina to Monroe County, Tennessee, and the typical rate jumps more than 50%, despite the 2 counties having roughly the same predicted damages from natural disasters.
Yeah, and the biggest reason for that drastic difference in insurance rates between these 2 counties is that North Carolina is one of the 11 states that allows regulators to veto requests from home insurance rate increases. And that has kept rates relatively low in states like California, but it's also prompted the exit of some of the big home insurers from the Golden State and leaving a lot of homeowners without any insurance. There is some good news, though. Nationwide, the level of rate increases has slowed as inflation has eased and many home insurers have moved back into the profit. But the upward pressure on rates will likely continue.
And you might want to shop around for your insurance because, Randy, you recently did that for us and you saved quite a bit of money.
As a matter of fact, I went out and quoted our car insurance and we saved $700 every 6 months.
That's huge.
And we're getting ready to shop our homeowners too.
So House lawmakers urged Trump to prohibit China's automakers from building cars in the U.S. That's right. Several dozen U.S. representatives told the White House that blocking Chinese cars should be a firm and non-negotiable priority. It is the latest salvo by Congress in a debate roiling the auto industry.
Hey, before we go on, we're at the halftime. We need to take a hard break.
You've been listening to Your Money, brought to you by Lifespan Wealth Management, proudly serving Middle Georgia for over 30 years. Our mission? Helping folks just like you plan for a secure and stress-free retirement. Need a trusted financial advisor? Call us today at 478-922-8100 and schedule your complimentary consultation at our Macon or Warner Robins office. Want to learn more? Visit us anytime at retirerelax.com. Because when you plan smart, you can retire and relax. And here's something extra. We offer free educational seminars for the community. If your group needs a guest speaker, give us a call and let's make it happen. That's 478-922-8100. Now, let's get back to the show.
All right, we were talking about how lawmakers are urging Trump to prohibit Chinese automakers from building cars in the United States. In a letter to Trump, Democrat Representative Dingell and more than 70 other Democratic representatives said that any effort to lower barriers for Chinese automobiles to enter the United States, including ones produced in other parts of North America, would pose a direct threat to American manufacturing, workers, and national security. The lawmaker said that via a letter that we must not cede the American auto industry to a strategic competitor intent on global dominance.
China's upstart car makers have been largely kept out of the U.S. for years because of the hefty tariffs on vehicle imports and a ban on Chinese connected vehicle software. But concerns over the prospect of these high-tech competitors breaking into the U.S. has ratcheted up as Trump prepares for a summit next month with Chinese leader Xi Jinping.
Xi
Jinping. The letter marks the latest effort by Congress to raise alarm over what domestic auto executives and lobbyists call an existential threat to the American car industry.
Trump has previously signaled he would be open to Chinese automakers coming to the U.S. so long as they build vehicles in the country. China's automakers have taken off around the world by selling highly advanced and often inexpensive electric vehicles, hybrids, and gas cars. U.S. auto executives have warned about their growth for years and described Beijing's subsidies for the country's car makers as an unfair advantage. Cars made by Chinese automakers are already sold in Mexico, and Canada plans to allow tens of thousands of new imports as soon as this year.
Yeah, at the Beijing Auto Show last week, some Chinese companies expressed a desire to come to the United States at some point if the political environment became more responsive and receptive to their entry. The holding group that owns the controlling stake in brands such as Volvo and Polestar said it is keen to expand in America with other names in the company's portfolio. The House lawmakers also said that Trump should maintain existing tariffs on Chinese automakers and automobiles and ensure that no car company in China establishes a manufacturing operation in the United States.
The federal government should also explicitly prohibit vehicles from Chinese-owned entities that are sold in Canada or Mexico from even entering the U.S., the letter said. Long-standing policy allows for cars registered in Mexico and Canada to drive back and forth to the U.S. Allowing such circumvention would undermine existing tariffs, weaken trade enforcement, and erode policies designed to support domestic manufacturing, the letter said.
Yep. That'll be interesting to see if they can pull that off, because I think Trump's trying to get more and more manufacturing here, but
yes.
I understand what they're saying. All right. Are you looking to get into an EV for the first time? Let's talk about how to avoid making a huge financial mistake. Higher gas prices have more people looking at electric vehicles, but if you're EV curious, it's important to remember that fuel costs are far from the only factor when deciding whether EVs make financial sense. American car shoppers have increasingly been eyeing electric vehicles in the wake of the U.S. and Israel war with Iran, which has sent gas prices up to an average more than $4 a gallon across the United States.
From the end of February to the end of March, searches for new and used EVs on Cars.com increased 25%. Half of surveyed car shoppers said that they are considering an EV or plug-in hybrid EV due to rising gas prices. Even car rental companies are seeing a surge of interest in EVs. Even as electricity rates have increased, charging an EV still costs less than filling up a tank of gas. A new Kelley Blue Book analyst estimates someone driving the national average of 1,015 miles per month would need to refuel about 3 times each month and spend about $147 or about $50 each fill up for gas compared to $60 for charging an EV at home. at the average $17.65 per kilowatt. And I have a friend
No,
down in
that's seven.
Florida.
That's 17.65 cents.
Oh, okay, just under 18 cents per kilowatt. And I have a friend down in Florida that just switched to a Tesla, and he cut his monthly gas bill in about a quarter,
Well, that's
Wow.
nice.
spending
Interesting.
not even anywhere close to.
That'll help your budget out.
Yeah,
Very good. Yet fuel costs alone do not make EVs the best financial choice for consumers. Simply put, spending $55,000 to save on $5 per gallon gas, the economics don't usually work out. A car should meet both your needs in terms of size and other features first, but don't rely on the price of gas to make your determination. The worst thing you can do is drive it for a year and say, you know what, this just doesn't work for my family, and end up trading in a car with thousands of dollars in negative equity, a more severe problem with EVs, which depreciate in value quickly.
Yep. And there's a high price to buy or lease an EV. The average price for a new electric car was $56,170 in March. Dealers lowered the EV prices from the average of $60,446 a year ago to compensate for the loss of the EV tax credit, which expired in September. Despite those reductions, EV prices remain considerably higher than the average $45,000 for the new non-EVs. Even the used EVs are more expensive than other options, with the average sales price of just a little over $31,000 compared to $25,800 for all other used cars.
Meanwhile, the price to lease EVs remains high as well. While there are still attractive EV lease deals, with some dealers offering payments of less than $300 a month with $4,000 down on average, the monthly payment on a new EV lease in March was $665 compared to $594 for non-EVs. At this point, the ideal EV customer is one who has the easiest way to charge and who doesn't have a long commute, not consumers who are price sensitive. And I will never forget that truck that we had to rent,
Yep.
that electric truck that got how many miles per, I can't remember.
It was terrible. It was a Silverado crew cab. My Silverado broke down, and
In Milledgeville.
and the only car in Milledgeville that we could rent was a 100% electric truck, and it had enough electricity in it to get us from downtown Milledgeville to the lake house, and with a level 1 charger. And I plugged it in for 24 hours and got enough to get us back to Macon.
That's it.
That was
It
it.
was frightening. We were terrified because we kept looking at the charger going, why isn't this going up more? But it was because of the kind of charger. No wonder nobody wanted to rent the thing.
And I had range. I had it for an entire week, and I had range anxiety the entire time.
That was terrible.
Because there was only one charger downtown Macon that I could get to, and there was always this Mustang in the spot. So
Yeah, that was fun.
yeah,
here's something to consider if you're looking at an EV. Recent policy changes have created potential hurdles for EV drivers. After allowing the EV tax credit to expire last year, the Trump administration has also halted funding to build charging stations and has proposed a requirement that chargers contain mostly domestic-made parts. Local incentives for EV buyers may still be available, but the uncertainty surrounding the EV market has slowed sales. Electric vehicles went from 10.6% of the new car sales in the third quarter of 2025 to 5.8% in the first quarter. Demands for hybrids, on the other hand, have continued to demonstrate solid growth led by Toyota.
yeah. As EV sales increased in other countries, the U.S. EV market has clearly entered a new phase. What comes next will be driven less by policy and more by fundamentals. More affordable products, smarter pricing strategies, and continued investment in the infrastructure. The bright spot for the EV industry has been the used market, where demand remains positive. Used models such as Tesla Model Y, with an average price of $30,100, Hyundai's Ioniq, Hyundai Ioniq 5, which is selling for about $25,500, and the Chevy Equinox EV for $26,200 were popular in the first quarter. So, I mean, I don't mind the electric cars, but if you don't have a place to charge them, that level 1 charger, which just runs off 120 volts, is just
That was terrible.
terrible.
Don't go there.
Yeah.
The U.S. debt tops 100% of GDP. The U.S. national debt now exceeds 100% of gross domestic product, crossing a once unthinkable threshold on the way toward breaking the record set in the wake of World War II. As of March 31, the country's publicly held debt was about $31.3 trillion, while GDP over the preceding year was about $31.2 trillion. That puts the ratio at 100.2% compared with 99.5% when the last fiscal year ended September 30th. That figure will likely climb for the foreseeable future because of the federal government is running historically large annual deficits of nearly 6% of GDP, which of course only adds to the debt.
Yes, it does. The government is spending $1.33 for every dollar it collects in revenue. And the budget deficit this year is projected at $1.9 trillion. And that little change from 2025 as Republicans' tax cuts kicked in before their spending cuts take effect. The final tally will depend on the Iran war, depending on tariff refunds and the strength of the economy. By itself, the milestone doesn't mean much. There isn't a special level where debt goes from being problematic to catastrophic. The ratio might bounce around in the coming quarters as tax receipts come in, tariffs rebound, go out, and GDP fluctuates in response to the inflation and revisions.
Right, but still the triple-digit threat mark is a potent symbol of the fiscal stress on the U.S. that has been building for decades. Lawmakers in both parties have expressed alarm. Sorry about that, but have given priority to tax cuts and spending increases with clearer short-term political benefits. We're certainly headed towards uncharted territory. There's no magic 100% versus 99%, but it's a scary place to be nonetheless. The debt to GDP ratio is economists' preferred metric for how much the country's borrowing weighs on the economy. As it rises, debt consumes resources that could be used more productively elsewhere. The government also becomes more sensitive to interest rates as debt grows. $1 in $7 of federal spending now goes to interest. A 0.1% percentage point increase on interest rates increase would cost $379 billion over 10 years, according to the Congressional Budget Office.
That's wild. Mm-hmm. Without changes, the U.S. is headed toward debt ratios already reached in France, Italy, Greece, and Japan, which have faced varying degrees of economic stress as a result. That said, the U.S. has more room to borrow than those countries because it controls the world's reserve currency and because of Treasury's debt position as a haven for investors. But that cushion is not unlimited. Economists warn that in the long run, higher federal debt will drive up interest rates, including on mortgages, car loans, and credit cards, and will undermine private investment by soaking up capital. Some economists say higher debt leads to higher inflation by putting pressure on the central bank to keep interest rates low and, in the extreme, print money to repay debtors.
Yep, the debt briefly exceeded 100% of GDP during the coronavirus pandemic in 2020, which temporarily shrank GDP and prompted steep government borrowing to prop up American households. The ratio then fell as stimulus ended, economic growth resumed, and high inflation boosted the level of nominal GDP. The U.S. hasn't finished a year with the debt above 100% of GDP since 1946. That looks likely to change. Unlike 2020 and 2021, the drivers of the deficit are structural, not temporary. As the interest rates are higher, some forecasts show that the ratio will reach 100.6 for the fiscal year ending September 30th and exceeding the record by 2030. These estimates use federal debt held by the public, which economists prefer to a commonly cited larger picture that includes debt the government owes itself. The GDP figures represent nominal economic output, unadjusted for inflation over the prior 4 quarters.
Debt to GDP hits an all-time high of 106.1% in 1946. It fell steadily in the following decades thanks to booming post-war growth, inflation, rapid reduction in military spending, and it went under 50% by 1957. As recently as 2008, debt was below 40% of GDP. Since then, the U.S. borrowed heavily to steer the country through the 2007-09 financial crisis and the pandemic. Congress cut taxes in 2013, 2017, and 2025, expanded government health coverage and veteran benefits, and did little to alter major spending programs. Even ardent deficit reduction advocates don't call for the ratio to fall as it did in the post-war period. They would be satisfied if the ratio simply stopped rising. That is a nod to the reality of the aging U.S. population, which raises the cost of Medicare and Social Security.
Projections show that debt will rise to 120% of GDP by 2036 and 175% by 2056. Those forecasts assume that President Trump's new tax cuts, such as the deductions for tips and overtime pay, expire as scheduled over the next few years. They also assume tariff levels that predate the Supreme Court decision restricting Trump's authority. The Trump administration projects that debt to GDP will fall as low as 88% by 2034. That estimate assumes significant tariff revenues and spending cuts along with much faster growth than CBO expects.
Barring that fast growth, even holding the debt to GDP ratio around 100% would require significant and likely unpopular policies. Over the next decade, cumulative deficits are projected at $24 trillion. Stabilizing at 100% would require some combination of spending cuts and tax increases worth about $10 trillion. Debt fears were a primary political concern from the late 1980s through the 1990s, and lawmakers were motivated to respond. Their tax increases and spending cuts, along with strong growth, yielded budget surpluses. Now, however, higher debt and deficits bring statements of concern, but little action to alter the U.S. financial course.
Yep. All right. Let's talk about the price of cars. We could be witnessing the end of cheap cars, and here's how it could happen. The end of cheap cars is looming over the American buyer. It's just one more thing to worry about, right? Yes, there were cheap cars once upon a time. To be sure, cars are way more expensive than they used to be. The average price of a new car is up roughly 10% since COVID-19. Combine that with the higher interest rates, car payments on average for an American household are up roughly $2,000 annually since 2019. And cars have been consuming a larger share of the average household income over the past few years.
There is very little that buyers can do to offset the increases. They could try to trade down to lower price models, but those are getting harder and harder to find. Many are assembled in Mexico, such as the Kia 4 and the Nissan Sentra, which both come in at just around $30,000. In 2025, President Trump's tariffs raised the price of a Mexican-assembled car by more than $1,000. Now it's time to renegotiate the U.S.-Mexico-Canada Agreement, or USMCA, which replaced NAFTA in 2020. The agreement faces a joint review in 2026. The deal is on the minds of industry executives. Foreign automakers threaten to pull their cheapest models from U.S. markets if the USMCA isn't renewed, according to the Wall Street Journal this week.
Yep. It's a negotiating tactic designed to ensure that billions of dollars of investment in North America infrastructure remains acceptably profitable. It isn't a bad tactic, as foreign automakers have some leverage. Most of the lowest priced new cars in America are made by non-U.S. companies. Some of General Motors' low-price options, for example, are manufactured in Korea. The Trump administration wants to ensure more cars are assembled in the United States. The sectoral tariffs of 2025 had an impact, shifting some production back to the United States and generating investment commitments from several automakers. The USMCA threat goes beyond imported cars. All automakers assembling vehicles in America rely on parts that are sourced from Canada and Mexico. The latter trend to produce lower value parts with cheaper labor.
A smooth negotiation with little change is probably best for the industry and for consumers looking for cheaper rides. Investors will have to watch USMCA in the coming months. The reviews could introduce volatility into car stocks, which haven't been great so far this year. Coming into the week, shares of Ford Motor and GM were down about 4% and 6% respectively year to date. The S&P 500 was up almost 5%. The issue came up on GM's first quarter meeting earlier on Tuesday. GM CEO Mary Barra said the company is working with the Trump administration to understand the impact on final vehicle assembly and parts. Beyond the stock and stock market, consumers will be interested in the USMCA too. Losing some sub-$30,000 options for cars isn't ideal.
Yep. All right. Let's move on to some scams. Reported losses to scams on social media are now 8 times higher than in 2020. Scammers reach people in many different ways: phone calls, texts, emails, but reports to the FTC Consumer Sentinel Network point to social media as the scammer's favorite. In 2025, nearly 30% of people who reported losing money to a scam said it started on social media, with reported losses reaching a staggering $2.1 billion. That's far more than the losses reported to any other form of contact, about 8 times the figure in 2020. Since most scams aren't reported to the government, their real losses are likely much higher.
Absolutely. Social media can be a great way to connect, but can also make a scammer's job easier. They might hack into your account to scam your friends or even create entirely fake profiles, or they might use what you post to figure out how to target you. And by buying ads, they get the same tools real businesses use to target you by age, interest, or shopping habits. At very little cost, scammers can reach billions of people from anywhere in the world. Last year, shopping scams were the most reported scam on social media. More than 40% of people who lost money to a scam on social media said it started when they ordered something they'd seen in an ad. Everything from clothes and makeup to car parts and even puppies.
Many ads led to unfamiliar websites, while others sent people to sites impersonating well-known brands offering big discounts. Most people said they paid for things that simply never arrived. When orders didn't show up, people often reported that items were When they did show up, they reported the items were counterfeits or very different from what they had been advertised. Reports show that these products were often shipped from China, with high return shipping costs making returns unworkable.
Yep. Investment scams, however, caused the biggest reported losses last year of the scams initiated on social media. In fact, 1.1 billion and more than half of the 1.1 billion was lost to investment scammers. These scams often started with an ad or a post offering a program to teach you how to invest. Other scammers posted as friendly advisors or created WhatsApp groups full of successful investors sharing glowing but fake testimonials. They directed people to fake but real-looking investment platforms. There, people create an account, see fake profits, and even withdraw a small amount. This builds trust, so people invest more. But there never was any real investments, and worse still, some people who lost the money this way reported secondary losses to scammers who said they could trace and recover lost money for a fee.
Reports show romance scams continue to thrive on social media. Nearly 60% of people who reported losing money to a romance scam in 2025 said it started on a social media platform. Scammers often tailor their act based on people's profiles, later inventing a crisis requiring money or casually offering investment advice to draw them into a fake investment platform. Other scammers trick people into sending nude photos, then threaten to send the images to their social media contacts unless they pay. That is horrible.
It is terrible.
Who does this?
Stop sending nude photos.
Scams that use social media to target people looking for jobs and housing are another problem. 1 in 3 people who reported losing money to a job or business opportunity scam in 2025 said it started on social media. And a recent analysis of reports about fake rental home listings found that about half were posted on Facebook. Scams on social media affect people of all ages. In fact, social media was the most costly fraud contact method last year in terms of aggregate reported losses for every age group under 80. Direct phone calls for those 80 and over took first place. Where people reported losing money, social media was also the most reported contact method for many age groups, including people in their 60s and 70s. In 2025, people reported more money lost to scams that started on Facebook than any other social media platform. WhatsApp and Instagram were a distant second and third. In fact, in 2025, people reported far more money lost to scams on Facebook alone than they reported losing to text or email scams.
I don't know why Facebook can't do something about this.
Right.
But to help you steer clear of scams on social media, there are a few things that you can do. First, limit who can see your post and your contacts on social media. And you visit your privacy settings to set some restrictions so scammers have less to work with. And never let someone you meet on social media direct your investment decisions, please. Instead, learn more about spotting these investment scams. Next is before you buy based on an ad, check it out. Does the company really offer that deal? Is that deal even real? Search online for its name plus scam, or add complaint to the search, and you'll be surprised at what you get back. To learn more about how to spot, avoid, and report scams and how to recover money if you paid a scammer, you need to visit ftc.gov/scams. And if you spot a scam, report it to the FTC at the reportfraud.ftc.gov. And as we like to say, a little education pays the best dividends. So get smart on how to spot these scams and protect yourself and your family. And we're at the end of our show, so we appreciate you spending the time with us this wonderful Saturday morning, and we hope you have a wonderful weekend. Have a great weekend, everybody.
Thanks for listening to Your Money, produced by Lifespan Wealth Management. As financial advisors, the main thing they do is provide retirement planning and advice and manage their clients' investment accounts. If you're looking for a financial advisor, please contact their office at 478-922-8100 to set up your complimentary consultation. You can learn more about them by visiting their website, retirerelax.com. And if you have a question or a topic that you would like them to cover in next week's broadcast, you can email Randy at rfmoney.com. They look forward to connecting with you next week. Have a great weekend, everyone. Securities and investment advisory services offered through Osaic Wealth Incorporated, member FINRA SIPC. Osaic Wealth is separately owned, and other entities and or marketing names, products, or services referenced here are independent of Osaic Wealth.